In the 2026 post-cycle market, the financial structures that traders assumed were stable are giving way to gravity. After peaking at $126,000, Bitcoin has entered a period of sustained selling. The asset is currently fighting to find footing in the mid-$60,000 range. This chart plots an extreme outlier prediction currently entering retail psychology. It projects a plunge from the current plateau down to $12,000. Reaching that $12,000 floor requires an 82% wipeout from current levels. That move would represent a 95% total cycle drawdown. This panic scenario stands in contrast to quantitative setups. Historical data suggests stabilization zones are more likely to form near the $60,000 level. Navigating this cycle requires differentiating between a standard bear market correction and a catastrophic macro failure. Projecting a realistic bottom requires evaluating competing structural models rather than relying on sentiment. The first model is the baseline technical correction. It relies on high timeframe support levels, which have held for over a decade, remaining firm. The second model is the macro tail risk scenario. This outcome assumes standard technical rotation will be abandoned in favor of systemic failure. To evaluate these models, we have to filter out daily volatility and focus on structural anomalies within the weekly moving averages. The probable floor of the market is found by dissecting these specific high timeframe signals. We begin by isolating a structural anomaly currently developing within the weekly charts. This chart highlights where the 21-week simple moving average crosses below the 100-week average. Historically, price action rallied above the 100-week line before these averages ever crossed. However, 2026 data shows an unbroken downward move, with no rally testing that resistance. A weekly death cross without a preceding relief rally indicates high underlying structural weakness. This lack of a bounce indicates that downward momentum is currently uncontested by macro buyers. This sequence suggests the current drawdown operates with a momentum profile differing from prior cycles. That momentum was localized by specific technical failures. This chart shows the failure of a bear flag formation, capturing the moment the lower trend line breaks. That breakdown included losing the 0.5 Fibonacci level at 70,300. The measured move suggests a $27,000 drop from this point. That vector points directly to a support zone between $58,000 and $61,000. This zone aligns with the 200-week moving average. Historically, this line has acted as the floor in every prior bear cycle. This confluence of the measured move and the 200-week average makes $60,000 a high probability target for macro support. There is a severe mechanical danger in front-running momentum, where overwhelming high timeframe pressure ruthlessly suppresses premature buying signals. Retail traders often attempt to catch a falling knife by buying whenever short-term momentum indicators, like the relative strength index, look oversold. This comparison shows the disconnect between lower timeframes and the macro trend. In this scenario, high timeframe divergence overrides lower timeframe oscillators, a phenomenon known as indicator squashing. Because of this effect, 4-hour oscillators can generate false buy signals for weeks while the price continues to bleed. To hedge a long position, traders must wait for the 4-hour stochastic to definitively turn upward, signaling a shift in momentum. Ignoring multi-timeframe divergence leads to premature entries. Patience for high timeframe confirmation is required for cycle survival. Once support is found, we can evaluate the parameters of the expected relief bounce. A bear market rally is likely to originate from the $60,000 support zone. Mean reversion dictates a mathematical ceiling for this rally. That ceiling is defined by the descending 50-week simple moving average. Market structure suggests the upward move terminates upon contact with this moving average, regardless of where the local bottom forms. The 50-week SMA acts as the boundary for the rally, capping the potential upside during this correction phase. This macro view contrasts the $60,000 support model against the void of the $12,000 tail risk hypothesis. Technical indicators that have defined every prior cycle floor do not currently project an 82% downside move. Forcing a drop to $12,000 would likely require catalysts outside of standard technical rotation, such as a global liquidity crisis or severe regulatory shocks. These black swan events are distinct from the harsh technical rotations currently visible on the charts. Effective risk management in this environment centers strictly on the defensive boundaries established by the most consistent historical market data. While the current moving average anomalies demand caution, the evidence suggests a bottom at the 200-week boundary is the higher probability outcome, placing the $12,000 target outside the established historical range.